gives us great pleasure to have the Executive Chairman, Kano State Internal Revenue Service, and a member of the Governing Council of our great institute, Dr. Sahad Abubakar, FCTI. We also have the honor from the administrative side. As administrator, the coordinating director, Emerging Taxpayers Group of the Federal Inland Revenue Service, our own Mr. Kabir Abba. On today, I'll be conferring with the status of doctorate, because when you hear his perspective, you will definitely know that he married to be a doctor. We are gender balanced in our institution, and we will be having a female giving our perspective even on the topic of discourse. And give us great pleasure to also have in our midst a partner with Deloitte and Touch Nigeria, our own Mrs. Ashiata Adoluaje, too, will be conferring her with a doctorate degree. Don't worry. The chairman, when the time comes, we do the investiture for you, because we know you deserve and you merit it. I will be coordinating the activities of today. My name is Olusesan Okunade. To proceed on the program, upon giving recognition and establishing the protocol, let me invite to the floor the chairman of this particular program, our own, the coordinating dean of our faculties in Chartered Institute of Taxation. Please help me make welcome Dr. Mark Abani, FCTI, our erudite speaker, as he gives his brief remark. Dr. Abani, you have the floor, sir.
Thank you very much. Thank you very much to our 17th president, Professor Ohagwa, and to past presidents, to all members of council. I will try and sit on existing protocols, as we always want to spend more time dealing with the technical hub of what we're here to discuss, all professional colleagues. This 11th edition is discussing the issue of taxing smart, incentivizing growth, strategic opportunities and safeguards under Nigeria's new surcharge and tax incentive framework. A lot of you will remember the pioneer status that was before, that aimed to try and push industries, but sadly was also the subject of, I wouldn't say abuse, but not being used in quite the way it was supposed to use. Now here, when we are talking about taxing, all the proposals around the tax reform have been to both increase revenue, but also to encourage growth, because you are taxing the fruit and not the plants. So the whole of what they're discussing now today is how these changes will make us more growth-oriented and smarter in what we are doing. We have, as our moderator has spoken, Olu, thank you. He has mentioned the people who are going to speak, and I'll be talking a little bit about each of them as we introduce them. But rest assured, we have covered the field, as we do always, with an erudite presentation by our Mr. soon-to-be Dr. Fidelis Chukwu. Olu, our MC, has now become an adjunct professor of NUC and will be doing all the confirmations as we go along. But on a serious note, this is something that everybody should listen to and learn. And we do hope that among the hundreds and possibly thousands who are listening online, that it includes a large swathe of our tax administrators, as well as our tax professionals, who are all members of this group. This is because as we progress, we're having to unlearn everything we know and relearn them, because the acts bring everything together in a completely different package, very much improved in that particular package. I'll just say a few words about, as we're running this, please, the chat room, you're all very welcome. But our chat room, we would prefer you use it for questions so that we can collate all of the questions. Even if we don't answer all of your questions online as we are going along, rest assured that the faculties are collecting all of these questions and will be providing an FAQ at the end of all the questions so that people are able to understand and benefit from what we have learned. For those who I know are going to ask for slide sets to be sent to them, you can go to our website. If you are registered and a fully paid up member, an incentive for you to be a member, you'll be able to download them from the website. And also, you're able to visit our CITN YouTube channel, which I'm sure they will be posting in the chat for you to copy if you need to. And that will allow you not only watch this one, which is being streamed live, but previous ones as well, so that you're always up to date. Another thing which people are going to ask us about are CPD points. These are all being handled administratively. There is a little bit of a bottleneck as we're making sure that those who are getting their CPDs have actually made their payments. So please, again, bear with us as we do that one. But with those few words, I will hand back to our moderator for the session in order for us to make progress. Thank you very much.
Thank you very much, my chairman of session and the coordinating dean for our faculties. Just like you've heard, please, the chat room is strictly for questions and answer. You need not to post your name or your membership number. Once you registered and you're already connected, we have actually had that. And like you said, visit our portal, CITN events with an S, .org, and you have access to the papers that have actually been presented. And like our chairman also mentioned, visit our YouTube channel for the previous edition and days that which we are having today, which is being streamed live. You can share the YouTube link also with other people to be part of the program and learn more. And on the final note, it will be of an advantage thing to you to visit our social media handle where you can get information on activities that are actually happening in the Institute. Before I invite the chairman to go on for the proceeding, it will be nice for our president to declare this program open. And on that note, join me to welcome the 17th president of our great institute, the man we refer to as a professor. You might think that he doesn't have it, but this is a professor par excellence. So I lend my voice and I join it with our chairman to welcome Professor Innocent Agua, FCTI, as he gives his opening remark. My president, you have the floor, sir.
Hello. Hello. Good morning, distinguished ladies and gentlemen. Please, MC, I'm not a professor. I'm just a minister. Good morning once again. While observing the already established protocols, I want to salute and greet our special guests, represented by the chairman of this occasion, Dr. Mark Abane, my boss and the coordinating dean of faculties of the Institute. I also recognize the lead paper presenter, Mr. Fidelis Chukwu, who is a partner with Pedapo and Co. I greet you. I recognize Alhaji Kabir Abba, the coordinating director of Emerging Tax Department Group in FRS, and also a council member of our great institute. I say good morning, sir. Dr. Said Abubakar, the executive chairman of Kano State Internal Revenue Service, also a council member of our institute. I welcome you and I salute you all. And the MC I greet you. I also recognize Mrs. Ashata Agbulaje, the partner, Deloitte, Nigeria. I greet you, ma, and I welcome you, ma. On others, the VP, the DVP, the HT, the past president and immediate past president, council members, registrar and chief executive, distinguished audience. On behalf of our great council and members, I welcome you all to this 11th episode and also use this opportunity to appreciate you for attending and also to thank all the numerous stakeholders who have invested intellectual materials, time, and every support to the Institute to ensure that this program is successful and is also continuous day in, day out. For our members, this is a great opportunity for all of us to ensure that we continuously learn and unlearn and participate in whatever the Institute is doing, and also to ensure that we are financially up to date to enable the Institute deliver on the numerous mandates bestowed on the Institute. So on these few notes, I thank you all for attending this webinar, and we look forward for our continuous partnership. And long live the Federal Republic of Nigeria, long live CITN, and long live our members and stakeholders. Thank you very much, and God bless you.
Thank you very much, our 17th president, Mr. Innocent Oagwa, for that opening remark. Before I yield the floor to the chairman of the session, I want to appeal to every one of us. The chat box is strictly, please, strictly for question and answer. The names, membership number, and other things is actually being captured as you registered for the program. We want to appeal. Do not drop your name or membership number. I don't want to go the route to say when I see your name dropped at the chat box, then I'll decline you of the of the MPTP credit hour. Please, the chat box is strictly for question and answer so that we can follow through. If we cannot answer the question here, the faculty is putting together FAQ question answers to some of those questions so that we can share and circulate to all the participants. On that note, let me yield the floor to the chairman of session to coordinating dean of faculty in the institute, our own, Dr. Mark Abani, FCTI. I'll come back during the question and answer time. My chairman, you have the floor, sir.
Thank you very much, my very able moderator. And thank you very much, my president, for your opening remarks and declaring the session open. I will now call on our lead presenter to make his presentation. Mr. Fidelis Chukwu, ACTI, is a partner in Creston Pedabo Professional Services. Fidelis is an experienced tax professional and a partner, and he's an associate of ICANN, CITN, and NIM. He's a graduate of management and, give me a second, sorry. I need to get this right. An accounting from Obafemi Awolowo University, Ife, and he holds an MBA in finance from the same institute. He began his career in Ijewere and Co. I think Ijewere was number 002 of membership of our great institute, and Pedabo in 2013. He has extensive experience in routine tax compliance services, corporate tax planning, tax audit, and advisory. I've had a privilege of having a quick look at his presentation before he does it, and I think we will all walk away from here very much enriched with the knowledge that he is going to give us. Fidelis, you have 40 minutes. I used an electronic timer. You will see my smiling face again when you have 5 minutes to go. Thank you very much.
All right. Thank you, sir. Yeah, the 17th president of our great institute, Mr. Innocent Ohagwa, and the council members present and their professional colleagues. It's a pleasure being here today to be part of this conversation, which the institute started sometimes on this the new tax law, discussing the new tax law and this 11th series of such webinars. So it's a pleasure to be here, and I must commend the Institute for the method adopted in discussing these tax laws. And this morning we'll be looking at chapter 7 to 9 of the Nigerian Tax Act, which deals with some specific provisions. And the topic that we'll be discussing this morning, which is taxing smart, incentivizing growth. And we'll be looking at strategic opportunities, safeguards, and compliance under the Nigerian new tax incentives and surcharge framework. You will all agree with me that the new tax law is one of the most discussed conversations among professionals today in Nigeria, because everybody wants to know, even as we prepare for full implementation by January 2026, everybody wants to know, how does it affect me? What opportunity is in it for me? And how do I strategize even as a business? So we'll be looking at those specific areas that have been asked to lead this morning in terms of this conversation. Like I mentioned, I'll be discussing chapter 7 to 9 of the new tax act. It's not new again. Like I said, this is the 11th series of this conversation. So there must have been a very detailed background concerning the tax laws, major highlights, and all that. And these conversations around the Tax Reform Act, which started in 2023, we all know that that exercise produced 4 different acts, which has to do with the taxing of businesses and the individual in Nigeria, including administration. So we have those 4 acts, which are the Nigerian Revenue Service Establishment Act, we have the Nigerian Tax Administration Act, we have the Joint Revenue Board Establishment Act, and of course the Fiscal Framework, which is the major one. We have the Nigerian Tax Act. So I'm not going to bore you with all the highlights. I'll just go straight because I have a very short time to do this. So we'll be looking at a surcharge, we'll be looking at specific areas, incentives, VAT, exemptions, and of course we'll be looking at some safeguard and anti-avoidance provisions that we have in these new laws. And of course, stamp duty is also one of the areas that we'll be covering in this exercise this morning. When we talk about taxing smart, incentivizing growth, of course, we'll be looking at what are those benefits that this new tax law has provided to taxpayers to encourage growth specifically. And of course, we'll be looking at it from the areas of incentives, we'll be looking at it from areas of tax exemptions, and of course, generally, what are the opportunities and benefits for taxpayers as a whole, and for us as individuals. You will agree with me that with these new tax laws, both as business, as individuals, we are all affected one way or the other. So we look at those specific areas. Starting with the first provision under this topic that I'll be discussing this morning, which is introduction of surcharge. It's new. We don't have this before, so that has just been introduced. And of course, this provision has provided for a 5% surcharge, which is going to be levied on supply of fossil fuel in Nigeria. And of course, when we talk about fossil fuel, we know what all this means. And it's going to be chargeable on either the sale, the earliest of a sale, supply, or payment, which is going to be on the retail price of the product. What this means is that the final consumer is going to bear the burden of this surcharge. That particular provision section also provides for the Minister of Finance to issue a guideline for the administration of this provision. So this is not going to be implemented until that gazette is issued by the minister. And this we also have specific products that have been exempted from this surcharge. Products such as renewable energy products, household kerosene, gas, cooking gas, and compressed natural gas. We know that this particular administration has been so vocal when it comes to use of CNG and some other clean fuel. So that is exempted to encourage users of CNG and all that. But of course, the section also provides that FRS may also issue a guideline for the administration of this such as FRS is going to be the one in charge. And the guideline that FRS may issue may include the collection and the kind of returns that affected entities will be required to file with FRS on a monthly basis. But again, this is subject to issuing that official gazette by the Minister of Finance. So that is basically on a surcharge. So we expect this to be effective as soon as we have that gazette issued by the Minister for the implementation. The next part we'll be looking at is in terms of income exempted from tax under the new provisions. We all know that even under the existing provision, which is the Companies Income Tax Act, Personal Income Tax Act, and every other provision, tax laws, we have some specific incomes that are exempted from tax. But what we have under the new one is that all those exemptions are now together, whether it has to do with individual or business. So we have everything together under this provision. When you talk about, when we look at the scope of exemption, of course, exemption of a certain income from tax is again in line with the government policies to stimulate growth, attract investment, and of course to protect certain businesses and individuals. It's not new. We all know again that small businesses for years that they've been exempted from payment of tax because government wants to protect those small businesses and to also encourage growth. So the same thing is also applicable under this new law. So we have those specific provisions to support innovation and to ease tax burdens on individuals. When you look at the new tax rate for individuals, for instance, you see that the first 800,000 is taxed at 0%. That specifically is to protect the low income earners. So we have similar provisions under this particular part of the Act, which also gives certain incentives to both companies and individuals. So those provisions that we know before regarding exempt income, we have a very long list of them, which I'm not going to bore you with that. We are all professionals. I will just talk on a few of those provisions and the new additions. Under this new law, we have gains accruing from disposal of assets by angel investors. When we talk about angel investors, these are people that give a seed fund to new business to encourage incubation of business and startups. So whenever they dispose the asset, I mean those angel investors, which also include venture capitalists, private fund, private equity funds, and all that, the law provides an exemption from gains derived from that. But again, there is a condition attached to that. The condition is that that investment, that asset, must have been held in Nigeria for a minimum of 24 months, just to avoid fund for startups, and in the next 6 months, person is already thinking of exiting in order to enjoy some tax benefits. So this condition must be fulfilled in order to enjoy that incentive. We also have income earned from a bond, whether state or federal government, still exempted from tax. That's interest income and from a bond issued by state and federal governments. Exemption is still there. We also have income from agri businesses. The law has also defined what agri businesses are, which include crop production, livestock, aquaculture, forestry, dairy, and such other businesses as described in the 13th schedule of the Act. So when you go to the 13th schedule, the law already listed all the various categories of businesses that qualify as an agri business. So there is full exemption from tax on those line of business. Dividend received from investment in wholly owned export-oriented business, that is still exempted. Profit of a company engaged in sporting activities, wages and salaries of military officers are fully exempted from tax. And of course, gains accruing on disposal of declaration and all that are also exempted from tax. So these are the specific items that have been listed that are exempted from tax. Again, under this particular chapter of the new act, we also have a new provision, which is kind of an incentive also for businesses to encourage those that are employing low-income earners. So there is a provision for that, which has provided for an additional 50% deduction. We all know that staff cost is an allowable deduction for tax purposes, but this particular provision grants additional 50% deduction. So in addition to claiming the full amount paid to the employees, companies or taxpayers that qualify for this incentive or relief here will take additional deduction on staff cost or employment-related costs incurred between 2020 for 2 years. So that incentive is available. And for this to apply, it also, the provision also provides that such deduction will apply specifically to wages, salaries, increase, and transport allowance, provided that such payment or the gross monthly pay of an affected employee is not more than 100,000 naira. Again, this is to also show that this incentive is to also protect the low-income earners, or to ensure that the companies also engage those low-income earners. And there's also provision under the same act that also recognize salary increase, where an employer also increase the salary of employee within that same period, so long as it's within the threshold. Such employer will also qualify to enjoy this exemption under this act. And when in determining the base or how much incentive that can be enjoyed here, the law provides that you need to consider the average that's the net increase in the company's staff, member of staff, not that a company will disengage the existing employees and bring in the new one just to claim this incentive. So the net will be considered. So which means you look at how many people join in the period and how many people also exit the company within the period. And as a form of protection for those employees that will also be employed under this particular relief or scheme, such employee must be retained for at least 3 years in that company. Any form of disengagement of the employees within 3 years will disqualify the employer from claiming this incentive. Donations, we know that issues around donation has always been a kind of controversial. What qualifies companies that are doing CSR to communities? You then have issues of not being able to take deductions. I think there is a more clarity in the law now, which has now given a clear direction regarding deductions of donation. And under this provision, donations are made by companies to approved fund bodies or institutions are allowed for deduction, whether it is capital or revenue in nature. Before now, know that only higher institution that you can make such capital donation to, but with this new provision, any form of capital donation will be recognized and the deductions will be granted. And of course, in claiming this incentive, the company must provide evidence of the donation to the relevant tax authority to be able to claim the incentive. And of course, the relevant tax authority will either be the Nigerian Revenue Service or the State Internal Revenue Service. Individuals can as well make donation and you get relief for that also. So the amount allowable for the purpose of this session is limited to 10% of profit before tax for that year of assessment in which the donation was made. The law has also recognized the fact that there could be non-cash donation by the donor. And where that is the case, then the law provides that the lower of the market value at the time of that donation or the original cost of that non-cash donation will be recognized for the purpose of deduction under this act. We have provision again regarding research and development. Of course, we know that research and development, any cost incurred even under the existing law, we have different provisions that you are treating it as a qualifying capital expenditure or amount allowable as a deduction, as a deductible expense. So we also have similar provision under the new act, which also provides for deduction of expenses incurred by any company on research and development for the purpose of the business. And the amount claimable here is limited to 5% of the company's turnover. So any excess of that amount will not be allowed for deduction. Where the research and development is transferred or sold by the company that is engaged in that research and development, whatever inflow or proceed from such will be recognized as an income in the hands of that company or individual making that disposal and will be taxed appropriately. So that is that on research and development. The next one, which has to do with economic development incentive, looking at the topic which we are saying incentivizing growth. The law has also recognized the fact that some incentives must be granted to taxpayers to encourage growth and investment in some critical sector of the economy. Before now, we have different incentives in different laws. We have the one in the IDITRA, which is income tax, the industrial development tax relief, which we all know as a pioneer status incentive. We have the gas utilization. We have all sorts of other incentives scattered in various tax laws. So under this new law, we have what is known as economic development tax incentive. And this is going to replace the pioneer status upon effective date of this new law. So the economic development tax incentive will replace that. And some of the major highlights of this is the fact that under the current legislation, which is the pioneer status incentive, we have some specific benefit that will change under this new law. One of it is that under the current incentive regime, dividend distributed is not taxable. Losses, capital allowance is suspended during the period and all that. So all that will change. And of course, in terms of the threshold, that will also change. Under the existing regime, with minimum of 10 million, a company can actually apply for the pioneer status incentive. But under the new regime, the minimum is about 250 million to qualify for any of those incentives, depending on the sector. There's been different conversations, different argument or school of thought around the minimum threshold, which seems to shut out small businesses completely, because most small businesses may not be able to afford this minimum threshold to qualify for this incentive. So that is another conversation entirely. And to qualify for this incentive, a company incorporated in Nigeria will qualify. We also have companies that are granted exemption from incorporation in Nigeria, or promoters of companies can also qualify for these incentives. In terms of issuance of this economic development tax incentive, the certificate, the same process that is still followed in obtaining the current pioneer status incentive will still apply. It will still be processed by the same agency, which is the NIPC. So that same process will be followed, which means applications must be made, and the company must also certify its production date and all that. So the same approval process will still be followed. The certificate will then become effective on the company's production date, as determined by the commission that is saddled with that responsibility, which is the NIPC. And of course, this incentive also provides that companies that are issued this certificate, NIPC must approve the certificate or issue it within 30 days of presidential approval. And in processing this, applicant must submit some specific information, which include the details of qualifying capital expenditure that the company will incur during the period, or evidence to show that they are going to incur that within a period of 3 years. So all these are required to be presented. And of course, the cost estimates and all that, so they need to provide that in processing that. The incentive can also be cancelled where certain conditions are not also met, even after the issuance of that certificate. One of the conditions that will result to cancellation of this certificate is, for instance, after the certification of a production day, if the company failed to commence production within 1 month, the certificate can be cancelled. NIPC also reserved the right to cancel the certificate under certain conditions. a company can request for cancellation if they say that there is really no benefit of enjoying this incentive, or the company is not able to meet up with the requirement. They can request for cancellation. Upon cessation or liquidation of a company, they can also, the certificate can be cancelled. Where the certificate is cancelled after the commencement of a production, right? You may then look at what is the effective date of that cancellation. If the company, for instance, in the situation of cancellation as a result of not being able to commence production within a particular period, within a 12-month period, then the cancellation, it will deem as if that incentive was not granted in the first place. And where it is cancelled after the incentive, or after the company has operated more than 1 year, the last anniversary of the company will be deemed as the cancellation date for tax purpose, which means they will only enjoy the incentive up to the last anniversary before that year of cancellation. So in this slide, we try to do a comparison of the current incentive regime under the Pioneer Status Incentive and the Economic Development as Incentive regime. So in terms of the period, under the current regime, we have a maximum of 5 years, but under the Economic Tax Incentive, taxpayers can get up to 10 years period of this incentive. 5 years initial and additional 5 years provided the company is able to invest 100% of its profit in expansion of the business. Capital allowance, which is one of the major areas under the current regime, companies under Pioneer status defer the claim of their capital allowance until post-Pioneer period, which is then deemed as the first day of business before they start claiming capital allowance. But under this new incentive, companies that are granted this incentive are required to compute their taxes like every other company, right? Claim their capital allowance and all that. Of course, the issue of effective tax rate of 10% is also applicable here under the new regime, whereas under the Pioneer Status Incentive, there is a full exemption from all taxes. And tax credit, there is no tax credit under the Pioneer Status Incentive, but under the new regime, which is Economic Development Incentive, there is going to be a form of a tax credit, which will be the amount of tax payable by the company in any year of assessment. So the expectation is that companies that are granted this incentive are expected to compute their tax. The tax payable under that normal tax regime, computing their tax like every other company, they will then be issued a tax credit for the offset. And where the 15% minimum tax is triggered, then the company will be required to pay that additional tax. Withholding tax on dividend, I've mentioned that earlier. Dividend distribution under the current regime is exempted from withholding tax, but under the new regime, withholding tax will apply. Threshold to qualify for this new incentive, the minimum is 215 million, and it could be up to 500 billion depending on the sector. There is no sunset provision under Pioneer Status Incentive, but that is available under the new incentive regime, which spans for a period of between 10 to 20 years, which means after that period, this incentive will cease to exist. So every company that wants to enjoy this incentive must apply for it and enjoy it within that sunset period. And in terms of application, under this new regime, there is an application fee of 1% of the qualifying capital expenditure, but there is a cap which says that the maximum payable should be around 5 million. And we have gas incentive also under the new regime, which provides for additional 5 years after the DTI period. In case of merger and acquisition, where businesses merged as one entity, they will need to apply for new certificates to continue to enjoy that incentive. And the maximum period they'll be granted is the maximum available to the merged entities. These are just the list of the different sectors that this incentive is available to. We have the minimum capital requirement for each sector. Go through this, but these are the lists. Okay. So these are the lists we have from different sectors. Sorry. Okay. Now, that's about incentive. So the next thing I will quickly talk about is the stamp duty. We all know that the stamp duty that we've been operating is governed by a 1939 law. So that has been repealed, and we have a clear provisions as regarding who is supposed to pay stamp duty, when is it supposed to be paid, when is it supposed to be stamped, and all that. And there are certain exemptions that are provided under this new Tax Act. And some of those exemptions include loan capital. For instance, we have under the current regime, there is no provision regarding on-lending. What we have currently in there is on-lending activities. One company takes loan, give to another, that one extend to another. At every level of transfer of that loan, stamp duty is expected to be paid. But under this new regime, on-lending is exempted from stamp duty. So it's the final borrower that is expected to pay the stamp duty on loan capital in case of on-lending activities. And of course, overdraft and short-term loans are exempted from stamp duties. Agreements, any form of agreement, contract provides for 1,000 naira flat rate. Currently, we have this disagreement between taxpayers and tax authorities. Under the 1939 Act, there is a provision for fees rate for agreement, but we have this JTB rate which provides for 1% of contract sum and others. So there is always that disagreement. So this new act has made a clear provision now. So it's 1,000. And contracts with consideration of below 1 million naira are exempted. Conveyance of sales is only real properties that are recognized for the purpose of stamp duty, which is land and building is recognized for stamp duty. And transactions involving conveyance of sales of less than 10 million naira is exempted from stamp duty. We also have leases. Under the existing provision, we have leases of up to 6% depending on the tenure. But under the new provision, the maximum amount payable as stamp duty for this arrangement is 3%. And also transactions of up to 10 million naira is also exempted. Transfer of shares will continue to enjoy the exemption. Value-added tax is also another major area that also that is also overhauled in these new tax laws. Under the new tax laws, we now have a list of exempt items, list of zero rated, and of course there is expansion in that list, and of course there is also clear definition of certain transaction or certain arrangement in the tax law now. For instance, services provided to and consumed in Nigeria now there is a clear provision. So this disagreement we used to have in the past regarding where the service is being rendered from and all that, so that there is a clear provision. And so long as the consumer is in Nigeria, such transaction is regarded as a vertical service in Nigeria. And of course, we have a clear provision regarding exported services and all that. So immovable properties, we also have a clear provision, which also provides that the VAT on immovable property is due where that asset is located, where the asset is located. So that is where the VAT will apply. Now, of course, there's a new provision regarding refund for VAT. So refund for VAT based on the new law now is expected to be done within 30 days of application. But that is again subject to provision of certain documents as may be requested by by the new Nigerian Revenue Service. So once that condition, all that is sorted, our refund is expected to be made within 30 days. Of course, there is still argument as to whether that request for document by Nigerian Revenue Service can translate to audit. Most of us believe that refund for VAT will be done without carrying out an audit based on the new provision, right? Again, there is also this provision that also says that that application must be made within 12 months of that transaction. So we have a long list of exempt supplies, which is an expansion of to what we currently have under the existing law. We also have a long list of zero-rated items. The major difference between the zero-rated and the exempt is that for zero-rated, for a company that is that has maybe incur VAT on a certain transaction that is going to be zero-rated, they are able to claim refund for the VAT they have incurred. So we have that long list of transactions. And of course, we also have input VAT also. That, again, is something that every company is also looking forward to, which also provides that the companies are entitled to claim input VAT for all their expenses, including their fixed assets. Again, this is going to affect even the way those transactions are reported in the financial statement. Before now, you all know that once you incur an expense that is not recoverable, both the VAT and the transaction value itself will treat everything as expense. But going forward, that is going to change, including that of assets. VAT will no longer be capitalized along with the cost of the asset with this new provision. There is also a provision which has also made VAT mandatory for claim of capital allowance. So all that is going to play out from 2026. The next thing I will talk about, which is business restructuring, which is also a very good one. Before now, there is always these issues around whether a business that is going into merger, whether they can carry transfer the unutilized capital allowance, losses, credit note of the subsumed entities into the margin or margin business. There was no clear provision under the Companies Income Tax Act before now. But in this new law, there is a very clear provision which has now provides that unutilized capital allowances, tax losses, including unutilized credit notes, will be available for transfer in the case of a merger. And there is also a clear exemption from VAT asset transferred in a merger arrangement. Similar such assets will also not be considered for the purpose of a chargeable gains under the Act. So this is a new provision which is going to have serious impact on a margin, on a merger arrangement. We then have sale and transfer of assets. Sale of transfer and transfer of assets have been divided into two. We have one in a situation where the sale or transfer is resulting into business cessation. There is a provision. We have another one where it's not resulting into cessation of business. There's been sort of confusion. How will a transfer of asset or sale of asset not result to cessation? But of course, there is a clear difference. If a company, for instance, is transferring, let's say it's involved in a manufacturing and decide to transfer its asset to another company, and that new company is not into manufacturing, is going to use that asset for trading or for another business completely, it means that that manufacturing business will cease. So in that case, this provision will be triggered. And where that is triggered, all those incentives that are available or for merger will not be available here. For instance, unutilized capital allowances and unabsorbed losses will not be available to be transferred to the acquiring company. Credit note will also not be available for transfer. Of course, we have talked about a VAT. There is a clear exemption for VAT. And in this case also, any gain arising from that transfer of asset will also be treated as a chargeable gain. The next type of arrangement under merger business restructuring that has also been recognized here has to do with a sale or transfer of business without cessation. That is, one company has transferred its asset to another company to continue with that same line of business. In that case, any unutilized capital allowances that is available in the old company or company transferring its asset will be transferable to the new business, and of course the asset itself will also be transferred at their tax written down value. And it will also not, if there is any form of a gain arising from this arrangement, is exempted as chargeable gain, so it will not be treated as a chargeable gain. And of course, VAT is also not applicable. So that is the bit about a business restructuring. Under the safeguard provisions that we have in the law, we have some anti-avoidance provision, which also make a clear provisions for compliance with the arm's length principle by related party when you have related party arrangement. So the new law provides that the companies involved in that kind of arrangement must ensure that they comply with the arm's length principle, that the transactions are done in line with that arm's length principle. And there's also a mandatory requirement for reporting of related party transaction to enhance transparency. In a situation where companies are related entities that have carried out their transaction in a manner that is not consistent with the arm's length principle, the tax authority is given a full power to adjust that kind of arrangement. It may include total disregard of that arrangement, it include adjustment of the profit or income arising from that arrangement. The whole essence here is to ensure that there is no profit shifting. So there is a clear provision under the safeguard provision that we have in the Act. There is a new provision also under the current Company Income Tax Act, Section 28 specifically. There is a provision that deals with waiver of liabilities. And that section provides that where an expense or an expense that had been previously deducted as an expense in arriving at a taxable profit is subsequently waived or forgiven, there is a provision that such will be recognized as income and be taxed. But there is no provision regarding where a transaction, let's say debt, loan specifically, is waived, right? We don't have any provision, whether in the company income tax or the capital gains tax, for taxing that type of income currently. What we have currently is if you have both principal and interest waived. Section 28 provides for taxing the interest that is waived, but there is no provision for taxing the principal itself. So we now have a clear provision for taxing such arrangement. And the new provision is that where capital is waived, such as a loan or principal amount, that amount that is waived will be recognized as a chargeable gain in the hands of the company that is receiving that benefit. So that is new. So we are going to see how that will play out going forward. And these are the repealed laws. Most of the laws, as we all know, they have been consolidated under this the Nigeria Tax Act. And these are all the laws that will cease to exist from 1st January 2026. We have the Capital Gain Tax Act, Companies Income Tax, Petroleum Profits Tax, Stamp duties, taxes and levies, approved days, casino, deep offshore, IDITRA, which is Industrial Development Income Tax Relief Act, and of course, Personal Income Tax Act, Value Added Tax, and Venture Capital. All these will cease to exist from 2026. So when you are looking at a taxing provision regarding any business, you must come back to the Nigeria Tax Act. And of course, when you are looking at administration and all that, then know that you need to go to the Nigerian Tax Admin. So all that will be repealed. We also have some other laws that are not completely repealed, but parts of those laws are amended or deleted. For instance, we have the Petroleum Industry Act, all the fiscal framework which we have chapter 6 of the act has been completely deleted. So anything that has to do with taxing of companies under the petroleum industry, those under that regime, you must still go back to the Nigerian Tax Act. But when it comes to governance and administration, you must still go back to the Petroleum Industry Act. So Petroleum Industry Act is not completely repealed, just the fiscal framework that has changed. We also have the oil and gas, we have the custom and excise tariff, we have the TED fund, we have the Nigeria lottery, we have the NITD, Nigerian startup, Nigerian mineral resources, we have the export incentive miscellaneous provision, FEMA Act, student loan. Some of all these laws, what has been done is that anything that has to do with charging of levy, taxes, and all that has been deleted from some of these laws just to align it with the new provision. And we all know that, for instance, TED fund, which is the taxing legislation for education tax, now we are not going to have education tax again from 2026. What we are going to have is development levy, which will replace all that. And of course, the NITD levy. So all these other laws have now been amended just to recognize the fact that there is no more taxing provision under these laws. And then we have some orders that have been revoked.
Dr. Chuku, pardon me.
All right, sir.
Just 5 minutes so that we
all
can.
Right, all right, thank you.
Thank you.
Yeah, so we have some orders that have been revoked. We all know that when you look at some provisions of the laws, there are some that gives minister power to issue orders, issue the regulations and all that. But with this new tax law, some of all those orders have been revoked. The VAT modification order 2021 have been revoked. We have the paragraph 2 of the SCP order has also been deleted. We also have the petroleum drilling and production regulations. So we have all these amendments in some of those different laws. The next thing that we also have, which is also within this the chapters we are discussing, chapter 9, we have a transition provision, which deals with transitioning. For instance, the economic development tax incentive, we know this is going to replace the pioneer status incentive. So we have a transition provision which provides that the companies that are currently enjoying pioneer incentive or that has been granted that incentive will continue to enjoy it until the expiration of that certificate. And companies that will be granted this new incentive we also enjoy it. Even, of course, we have talked about the sunset provision, which provides for timeline for which this incentive will last. So if, for instance, a company is issued this certificate in year 19 for a sector with a 20 years sunset, it means that the company can still enjoy it fully, even after the sunset. So those are some of the provisions that transitioning provisions that we have in the Act. We also have a transitioning provision regarding the capital allowance. We know that the rule for capital allowance has changed. We now have class 1, class 2, and class 3 assets. And we have alignment of years, useful lifespan for some of those assets. So under the new law now, what is expected is that if there is any asset with a useful life of 5 years under the current second schedule, and under the new schedule or the new law now, that asset now has a useful life of 4 years, which means it has a shorter lifespan. The rule is that companies should claim all the remaining capital allowance in one single year. So it's possible that in 2026, you are going to see companies claiming a whole lot of capital allowance because some of all those assets they are carrying with different rates. They need to then claim everything and then transit to the new regime. And there is also a compulsory 1% notional value that must be retained in the books just to be able to keep track on the assets to know when it will be disposed. But this 1% does not affect the capital allowance claiming. Companies will still be allowed to claim their capital allowance 100%, but they must retain 1% in the books just to be able to track the asset to know when it will be disposed. And lastly, we have general interpretation in the law, which is then classified based on business and accounting terms. We have the agreed, and of course, we also have a finance tax incentive. So we have different items that has now been explained in the law. For instance, we have the minimum effective tax rate, which is 15%. We have the startup, what is startup, the angel investor that we talk about. The law refer us that we should go to the Nigerian Startup Act of 2022. For anybody to qualify for that, then the person must fall within that definition in that act. An issue of beneficial owner is also very new to in the law. For now, we don't have that specific provision. So there's a clear provision now that deals with the beneficial owner. And this, you will mostly see this where you have an arrangement where shareholders, probably the ultimate shareholder is sitting somewhere maybe at the 5th or 6th layer of another company for certain reason or for some tax consideration. You may need to check for the beneficial owner, who is the real owner of the business. And in terms of governance and tax administration, we also have some specific provision and definition in the Act. So we have all these a long list of them that time will not permit us to start going through all of them. The important one I would like to talk about is residency for individual. We have a clear definition of who is a resident individual for tax purpose in Nigeria. Even though this, again, is also generating a kind of conversation because of all the different combination of triggers to qualify as resident, which include even if you live abroad or you have a place of habitual abode in Nigeria, or the person has substantial family or economic ties in Nigeria, or the person has spent 183 days in Nigeria in any 12 calendar month. So once all these conditions are present, the new law is saying that the person is a domicile in Nigeria. And of course, non-residents, once you spend less than 183 days, you spend more than 183 days outside Nigeria, you don't qualify as a resident in Nigeria. So we have all those provisions under the general interpretation, which we see under the Chapter 9 of the Act. And in conclusion, we expect that this new law is going to bring some kind of change to our tax administration. It's going to change the way the revenue authority administers, and of course for taxpayers, there are kind of clearer provisions and incentives that are also available that is expected to stimulate growth going forward with these new provisions. So that's, thank you very much, sir. Thank you.
Thank you so much for that excellent and erudite presentation. You managed to get a few extra minutes in because I went offline briefly, but I'm back online.
Okay.
You've covered a massive amount of material, and as I said, there is a lot that we have learned through this process. You've touched on some very key issues of a generic nature, but which have also got mighty impact, and not least is the last one around residents and all of those changes. But also, basically, you've covered the field. Because of time, I'm not going to try and recap what you have said. We have a number of questions in the chat box. And can I please remind people they should only be using the chat box for questions, please, not for greetings. Thank you very much for that. So to discuss this presentation by Fidelis Chukwu, who I know Olu will soon be awarding a doctorate, if not a professorship, may I now call on Dr. Zaid Abubakar? Is he online?
Please call Dr. Abba.
Okay. May I please call Dr. Abba? Mr. Abba is the Coordinating Director, Emerging Markets Group on Innovation and Tech-Driven Compliance for the Federal Inland Revenue Service. He's an outstanding professional with lots of experience, and he is part of the key to make sure that FIRS is able to fully implement and take forward this myriad of changes, because the proof shall be in the pudding. Ms. Abba, you have 10 minutes, I'm afraid, to make your comments here again. As long as I'm not kicked out, I shall come back and tell you when you have a minute or two to go.
It's all right. Good morning, all. It's my pleasure to be here, and of course, commend the leadership of the CITN for organizing this. I was discussing with the coordinating dean of the faculties on that what we are doing at the FRS is, of course, to sensitize our staff first, and of course, all major stakeholders. Mr. Fideli, this is a paper well presented, and of course, in the future, we'll definitely reduce a lot of clashes that we've been having. As you can see, this whole tax laws that were, passed by Mr. President is all tailored to grow the economy and to make it, easy for everybody. If you look at the surcharge regime, which is what is virtually new in the whole system, and you can see it's a good thing, because it's going to ensure, high revenue potentials for government. And at the same time, it has taken care of small business households because they are exempt from, on this surcharge regime. If you look at the cooking gas, the CNGs, household kerosene, and all that, and of course the renewable energy product like the solar and wind, it's not they're all exempt from this surcharge. And if you look at the income tax exemptions also, taxpayers with whose turnovers, as he rightly pointed out, with less than 50 million are exempt from paying any form of taxes. And this is also to allow them to grow. Even though if they have fixed assets of 250 million and above, they are subject to, to pay such taxes. And if you look at the VAT, the expanded items that are exempt from VAT, there's also another good one in the right direction. And the reduced withholding tax burden and all these good things that the law has come into, I mean, they're all good, going to help the economy in the long run, which will also encourage voluntary compliance. So what I just want to add is the fact that some of these things that were discussed has to get some clarifications and some gazettes from the Federal Ministry of Finance, which we're, working on to ensure that everything is, put in place. And when you talked about the leakages we used to have in the past on pioneer statuses, it has now been clearly defined on the sectors and even the durations and how this is going to be implemented going forward. It's the right point in the right direction. And even on individual, you could see the 800,000 naira and below exempt for paying personal income tax. And another good one, it's the fact that we don't have what we call the medium now. It's either you are small or you are large. It has been clearly defined, so there are no ambiguities going forward. All this I can say to summarize it all, it's all in the right direction. And then at the end of the day, I think the private sector, or rather the taxpayers, should just be ready, to comply with all these new provisions that we have. And on the part of the small companies, it's all tailored towards making it easy for them and to make it easy for them for easy compliance in the future. So I think on that, except if there are specific questions, I'd want to say that the tax administration has been, simplified, and then the exempts are also clearly stated now, unlike in the past where we used to have issues about whether this is exempt or this is not exempt. So on that, I think I want to just wish everybody well. And I also want to encourage us to continue to have more engagement in the future so that we'll be able to understand these things well, which will help in, curbing whatever clashes that we're going to have in the future. We at the FRS are ever ready to ask questions, to make clarifications going forward. And then I wish all of us the very best, come 2026, 1st January, when these things will be put in place. Thank you very much.
Thank you very, very much, Mr. Abba, for that comprehensive yet to time presentation. As you say, the devil is in the detail. People will need to change. It's a completely new system. Penalties will also kick in. So it behooves all of us as professionals, especially those advising clients, as well as those who are administrators, to be totally up to date so that we ensure that all these rules move forward smoothly. So thank you very much for that. The MC moderator of the event will be taking down the questions and will lead the questions. There are a number of questions that I can see in the chat box that are extremely relevant to what you are discussing. I've had to change location, so I'm sitting in my car with a limited amount of access in order to be able to continue this conversation. May I call Mrs. Aisata, who is a partner in Deloitte Nigeria, an expert in international tax and regulatory tax, and a very, very experienced tax professional, to please make her own comments, again with the same 10-minute time limit, please, ma.
Good afternoon, everyone. Pleasure to be here. And Thank you, CITN, for providing this opportunity for people to learn and for us to share knowledge. So my comments would not be to dwell too much on the incentives that the lead presenter has spoken about largely. It's to talk about the practical realities and some transitional issues that may come as we continue to explore this. So we talk about the fossil surcharge. This is well, for now we've said it's going to be effective upon regulations to be issued by the minister. So they say the minister may issue regulations. So long as it's not been practical, we will see what he holds in stock. But it appears to be an attempt to impose levy on certain products where we've removed VAT on that. You recall that there's VAT removal on petroleum products, and then there is this surcharge. So we have to balance that and see what the implication would be for the economy. There's the framework. Whether they will now activate it is another issue to be determined, as the case may be. So that is on one hand. Then we talk about the EDTI. So EDTI, we've talked about what it entails and some of the practical realities that may arise from these around the current position and what the EDTI offers. Under the current law, a company that has a new line of business that has been in existence, but maybe wants to have a new plant, may not be able to enjoy the PSI. But based on the framework that we have under the EDTI, so long as the new injection of capital qualifies and falls under what it is in the 10 threshold, there is room for companies that are seeking to open a new line of business to get the EDTI. There's also some of the transitional issues. Companies that are existing, that have pioneers currently, there is nothing that presupposes that they will not be able to enjoy the EDTI. Again, I suppose the EDTI will stand alone and all the conditions will be evaluated to ascertain whether or not they will be able to qualify for that. One other consideration is the practice, or what parties are to entail. So as part of the conditions to grant the EDTI, is that there would be production day certification. As part of that, it will be done by the IID, which is the Institute of that's an arm under the Ministry of Trade and Industry. And as part of the process, currently they do a certification or evaluate the assets. FRS will also evaluate or certify the assets. So I suppose the IID and FRS may have to come together to have a seamless approach so that applicants will not have to go through the process more than once, or at least the documentation used for one will be available for use in the other instance. One other consideration is VAT. So we've talked about the input-output claim for companies that are not in manufacturing, which is a fantastic idea. One of the considerations of what are the impacts that may affect taxpayers would be companies operating in industries where the counterparty is meant to withhold VAT. So people that are trading with oil and gas entities, with banks, with telecommunication companies that have obligation to withhold. What that means is that those companies, although they have the right to claim input against their output, they would always be in a refund position. So that is something that we may consider and have maybe framework guidelines or exceptions to ensure that companies enjoy the full benefits of the law, as the case may be. We've talked about the free trade zones. What the law seeks to do now is to give clarity to say if you are in a free trade zone and you're supplying up to 25% of your product to the customs territory, there will be tax proportionately. What the language of the provisions, when you see paragraph 3 and paragraph 4, there may be some opportunity to maybe circumvent the provisions, not because taxpayers don't want to pay tax, but the provision of the law are there and may not be clear. So it's something that we need to look into accordingly. Another one is that there may be conflict between the provisions of the second schedule and section 186 of the Act itself, which says VAT are exempt when it is supplied to an entity in the free zone. But then again, when you look at the second schedule, it says supplies to entity within the free trade zone shall accrue applicable taxes. So in one view, it's to say, when you say applicable taxes, you mean all taxes. But in another view, it said there's been an exemption. So in that case, VAT does not apply. But it's something that there needs to be more clarity on to avoid such conflicts. We talked about small companies having zero tax to pay. That's a company with less than 50 million naira turnover and less than 50 million naira turnover and with asset base of less than 250 million. This is a big deal, and I think it goes to part of the initiative, the underlying notion of this NTA, which is to ensure or to encourage a lot more companies to formalize. And what this means for small businesses is that if you are a company and your turnover is less than 50 million, that company does not pay tax. If you earn income from that company, you may pay tax, but at least that business retains that income and continues to grow. If you are an individual running a business and you're running that business in that manner, and you're earning this income, you may not be able to enjoy this incentive in that manner. So it's to ensure more people to corporatize, more people to file relevant records, more records for the company, and then encourage more. That leads to more information sharing, more available information to the government, and ultimately more taxes eventually, because the tax net will be wider. So we encourage companies to grow. The tax that should have been plowed back in the business and continues to grow. So this is a major consideration for small businesses to evaluate, going to corporate or maintaining the small businesses that they have. One other one is around mergers and acquisitions, laudable initiatives. We've had what this means is that companies do not have to be within the same group to enjoy the relevant exemptions under the business restructuring. But there are some other clarifications that will be required. So when you look at business restructuring, they say business restructuring in accordance with the law. So these are things that needs to be clarified and spoken about in more details. One example is to say VAT on business restructuring carried out in accordance with VAT on sale of assets under a business restructuring carried out in accordance with the Act will be exempt. So what this means because I'm a taxpayer, I'm an individual. For businesses would be nobody wants to pay tax. It was to structure any disposal of asset as a business restructuring. So if that is the intention, it is fantastic. Otherwise, there's need to actually clarify to avoid issues that Mr. Abba mentioned, that we do not want conflict between tax authorities and taxpayers. And on this note, I think I'll give it a rest and listen to and wait for the questions. Thank you.
Thank you very, very much, Madam, for your erudite additions and for putting the practical spin on this discussion. There are a significant number of questions that have been asked. Unfortunately, Dr. Zaid, who's in transit, may be having the same problems I had of connectivity. So if he does join us, we will take his own view, which is extremely important because it represents the subnational view around this area, given that he's the chairman of the Kano IRS and also was a member of the Presidential Reform Committee. At this point, may I hand back to Ulu, our able moderator, to please coordinate the questions and answers. We have a bit more time this period to actually do justice to all the significant questions that we have there. Moderator, back to you, sir.
Thank you very much, the chairman of session, for this great opportunity. I want to lend my voice to all our paper presenter, the lead paper, the discussant, Mr. Fidelis, Mr. Kabir Abba, my own sister, Ashiata Guluaje. We want to appreciate you greatly. So I will bring the questions across to us. I think with the ample time we have, I think I can draw out about 9 questions. I will bring it before us here. And if individually we have additional contribution, we can just lend our voice to it. The first question, let me take it to our lead presenter, Mr. Fidelis. Somebody is asking that Section 21 talk of any expense on which VAT is not paid as not being allowable. Please, can that be assumed to include all expenses reported in the financial statement? Mr. Kalu actually wants to look at that. And let me combine this with it. Somebody is asking, kindly confirm if the new relief only apply to employee or individual paying rent. What about those staying in their own houses? Will there be relief for them? I think we've done justice to this in all our program, and I would not want you to respond to this. Why? I want this particular person to review our other presentation. Go to CITN YouTube link, listen to them, and that will give you a deeper insight into that, so that can be a situation of you visited. Let me combine this question for you, Mr. Fidelis. On the residence rule, must all the conditions be met or any one of the conditions? Can you do justice to these two questions, Mr. Fidelis?
All right, thank you. So on the first one on the VAT on expense, so this is a new provision. And if you follow the conversation when the whole tax reform act were being discussed, the whole idea is to focus more on indirect tax, and that was part of the proposal to reduce corporate income tax. So the new rule is that payment of VAT is a condition for claiming deduction for any expense. So which means you must show evidence that VAT has been paid. And that will include even where you need to apply the self-charge rule. You must ensure that that is done before you can claim deduction for your expense. And that, again, extends to claim of capital allowance. It's also a condition that before you can claim capital allowance, you must show evidence that VAT has been paid. And if it's imported asset, you must show evidence that import duty has been paid. So it's a condition that must be met. And that, again, is applied to all the expense reported in the financial statement, so long as it's an expense that is VATable. Of course, recognize that some expenses are not VATable, like interest. You can't ever, the revenue authority will be asking you to provide evidence of payment. If it's an exempt transaction, nobody will ask you for VAT. But if it's a transaction that is VATable, that is a condition that must be met. And the second one, which is on rent relief, I think I'll just talk about that. Yes, rent relief is available to everybody, right? So long as you are paying rent. But if you are living in your own house, I don't see how you want to claim that really. And to the best of my understanding, the main reason for bringing in this provision is to be able to disclose the information of the property owners, right? So if you are the owner of the property, then you are not paying any rent, so there is no relief. But if you are individual, whether in employment or a sole proprietor, but you pay rent, then you are eligible to claim that maximum of 500,000 naira. And the last question, which is on resident rule. So this is new in the law. And if you look at the drafting of that provision, it's saying all those conditions, or so you don't need to meet all the conditions. Once any of it is triggered, then you're automatically resident in Nigeria. So even where you don't have economic ties in Nigeria, but you have met the 183 days threshold in Nigeria, you're automatically liable to tax in Nigeria. But again, whether you then need to pay tax in Nigeria is another conversation. Again, must be earning income from Nigeria before you talking about a payment of tax. So any of the conditions, you don't need to meet all the conditions together before that new rule will be triggered. Thank you.
Thank you very much, Dr. Fidelis. Don't worry. I'm sure the next engagement with us will be stepping you up to the professor level, which I'm sure my chairman will approve it from his side once I nominate you to that professor level. Let me give this question to Mr. Kabir Abba. Someone is asking a question regarding the introduction of the introduction of taxation of dividend income. He is saying that since dividend is a distribution of profit of companies that has previously been subjected to company income tax, will it not amount to double taxation if such dividend is being subjected to another form of taxation? That is one. The second aspect I want you to handle, Dr. Kabir Abba, is somebody wants to know if the current minimum tax of 0.5 will still be in force or will no longer be applicable from 2026 when the new tax act will be implemented. You have the floor, sir.
Well, thank you very much. Going to starting from the second questions, you see all these previous tax laws has now all been consolidated into one. So that will not apply anymore. So what this is saying now with regards to minimum tax is no longer there. All that we have are small companies and big companies. That is just it. So depending on the turnovers now, if the turnover is below 50 million naira, you not pay. And if it is above, of course, you now pay. So all those things have all now been consolidated, which is one of the reasons for these new tax laws, because it was so cumbersome in the past. So it has all been put together now to make it simple and very much simplified. So on the issue of the second question, the issue of dividends, withholding dividend, if I get you right, you are saying that if it has been charged, or I don't really get it. Sorry, can you listen?
Second question, sir.
No, the first question.
Yeah, no, that's the first question now, withholding
Yeah, the
dividend.
first question is speaking to somebody is saying that the introduction of taxation of dividend income. He is saying that since the distribution of that profit is from the profit of company that has previously been subjected to CIT, will it not be double taxation if you are tasking that dividend again?
No, it will not amount to double taxation because you can use it as a credit also in the future. So it's not double taxation. It's still something that you can claim, in the future as a credit. So it's not double taxation.
Okay. Thank you very much. Let me come to the woman amongst us. Somebody wants to get clarification and is asking, will 5% surcharge on petroleum not impact negatively on transportation cost and ultimately the cost of living, putting in quote, inflation? And another question subject to, can company apply for pioneer status now? Also, company in free stroke export processing zone, are they liable to minimum tax? Mrs. Abdullah, can you do justice to these two questions?
Okay. So for the first one on whether the surcharge would impact inflation, on the face of it, it appears so, but as we have it now, we do not have the regulation that puts the surcharge in place. So we cannot ascertain whether or not it's going to come into place or otherwise, but there is a framework for it to come to place should the government think it's required. And considering all other implications for the economy. That's the first question. The second question is around application for Pioneer. Can you apply for Pioneer now? Yes, the law still exists. You can still apply for Pioneer. And there's a savings provision in the NTA that says all acts done under the act will seem to have been validly done. So the NIPC still has powers to consider applications. Now, the consideration would be, would your application and all the other documentation be ready for approval before December? If yes, fine. If not, I would still say there's still room to finalize applications that are in or that have reached an advanced stage with all the documentation in place under that rule. There is nothing that says an application for Pioneer should end now. So companies enjoying Pioneer continue to enjoy them, and the same way, in the same vein, application under the old law would not just be thrown out because a new law has been enacted. The third one is around companies in free zone, whether the provision of minimum tax applies to them. Yes, you would see that the provision of the second schedule says subject to the provision of section 57, which is the one on minimum tax. So it's something that will be evaluated. And again, the minimum tax too is subject to guidelines and regulations. We do not understand how that will come out in play eventually. So when we say the guidelines, when we say the regulations, we'll know what the impact will be ultimately, as the case may be. But there is a framework for it to be considered for all companies that are getting exemption, for us to consider that section 57. I hope that is clear.
Thank you very much, Asheta, for that response. Let me come back to Fidelis on this question, and it bordered around the CGT. Could you go over the implication of the new regime on the capital gain tax, specifically for share transfer? And somebody is also asking, can you say no more income or profit or gain chargeable to tax on profit or gain from disposal or of property of a fixed asset? You assist to combine that with this. Will stamp duty applicable to tenancy or land purchase agreement under EDTI? What will be the implication for the additional 5 years if less than 100% profit for the year is used for expansion of business? The third one, the 15% ETR applicable for profit and both profit and loss. Can you assist in combining these two questions together, Dr. Fidelis?
Yeah, thank you. So the first question on the transfer of shares and the disposal of assets. So we have a clear provision under Chapter 2 of Part 2 of the NTA, which provides for taxation of chargeable gains. Before now, we have the capital gain tax, which occurs as one of the laws that were repealed. Capital gain tax has been repealed, and that now provides that chargeable gains will be taxed like every other income, either company or individuals. So when it comes to disposal of or transfer of shares, disposal or transfer of shares is subject to tax, income tax at 30%, because it's going to be treated as chargeable gain, and that will be added to the assessable profit and tax at 30%. However, and that exemption is where the sales proceed from such disposal or transfer of shares is less than 150 million. Under the current provision, we have exemption of disposal of shares if the proceed is less than 100 million. But under the new provision is now 150 million within a 12 calendar month, provided that the gain is not more than 10 million, must be met concurrently before exemption can be claimed. That is, the proceed must be less than 150 million and the gain must be less than 10 million. So if the proceed, for instance, is just 50 million, but the gain is 15 million, there is no exemption, right? So the two conditions must be met. So that is for shares and assets generally. The law has provided for two different treatment of assets when it comes to chargeable gain. Before now, we used to compute all this balancing allowance and all that, so that is no longer applicable. What is expected going forward for 2026 is that assets that have been used for business on which capital allowance has been claimed, the law is saying that if there is disposal of that such asset, what should be done is to just deduct the tax written down value of such asset from the proceed, and the balance should be treated as income. And for assets that capital allowance has not been claimed, like investment property and all that, when there is disposal, then you need to compute the chargeable gain by looking at the proceed, then less the cost of acquisition and other attributable costs such as a cost of protecting the asset, maintenance, and improvement and all that. So you deduct all that to determine your chargeable gain, which will then be added to the accessible profit and tax at 30% along with other incomes of the company or individuals. And of course, for individuals, you are going to be applying the new tax rate to know where that income will fall within that table and apply the appropriate rate. So the second question on the stamp duty on tenancy agreement and a purchase of a landed property. Tenancy agreement will be treated as a lease arrangement. And of course, when you are looking at lease, you'll be looking at the tenure of that lease arrangement. Though there is exemption, and the exemption is for lease that is below 10 million naira, that is exempted from this, or the law says the higher of 10 million or 10 times the minimum wage. We know that 10 times the minimum wage will give you around 700,000. So let's just take it as 10 million. So 10 million is exempted, but you then need to look at the tenure of that lease arrangement, which provides for maximum of 3%. So tenancy arrangement that is more than 1 year and all that will definitely be treated as a lease, and of course stamp duty will apply. And for purchase of property, buildings, now I mentioned that conveyance of sales, only real property that is recognized for the purpose of stamp duty for conveyance of sales, and that is also subject to stamp duty, with the only exemption, which is where the value of the property in the transaction is less than 10 million, that is exempted. So aside that, whatever transaction that has to do with property, purchase of property will attract stamp duty. And lastly, on the effective minimum tax rate, this is only applicable where there is a profit. So if there is no profit, there is no tax. This again is meant to replace what we have currently as a minimum tax, where minimum tax is applicable on turnover. So that has now changed. So going forward, before this can be triggered, there must be profit. And that 15% computed here was, for this to be triggered, that means that the tax paid under the normal CIT computations, where you take your profit before tax, make the necessary adjustment and take capital allowance. This will only be triggered where such tax is less than 15% of the profit. And the new act has defined profit to mean profit before tax less 5% of personnel cost and depreciation. So when you do that adjustment, then you compare with the tax you have computed. So it should not be applied in a loss-making situation. There must be profit before this can be triggered. Thank you.
Thank you very much, Mr. Fidelis, for that response. Let me come back to Dr. Abba to assist in doing justice to this question. Someone is asking that what is the state of consumption tax in the new tax law, stating that some states are still pursuing consumption taxes on company. And the second we want to actually add to that is that with the provision of the new tax act, will it be applicable to account of 2025 financial year or 2026, especially for companies with December financial year? And let me do justice to those two questions. I bring the last one to Ashiata. Thank you.
Okay, thank you very much. On the question on the consumption tax charged by some of the states, all this has now been harmonized into one. And if you go through the Joint Revenue Board Establishment Act, you can see that. So everything is now put under one umbrella. And the Nigerian Revenue Act supersedes all other taxation acts in the country. And on the second question, because the effective date is 1st January 2026, so it has to do with the 2025 accounts. And all that is in place now will still continue till the 31st of December 2025, when the new revenue acts will take place come January 2026. It's going to be for 2025 accounts. Yeah. And for the states, how I wish Dr. Zaid is here, because I'm also a member of the Joint Tax Board. So all these taxes charged by the states, if you critically look at the new Joint Revenue Board Act, you'd see that all these things are now put in place, and the Joint Revenue Board Acts will now perform a lot of these functions that these states are doing, and it's going to be an independent body with an executive secretary there. So probably when this webinar series gets to that, it should be more clear to everybody. Thank you.
Thank you very much. And on the final note, let me come to you, Ashiata. Somebody is asking, does it not amount to double taxation if non-resident citizens are being taxed again in Nigeria simply for owning assets in Nigeria, even when they don't meet the residence rule? Your response today is Ashiata.
Thank you very much. So generally, even in most jurisdictions, basis for tax is different. So one of the major bases of tax is having an asset in country. So if you have an asset in country and there's taxable income from that, there will be tax. There is also the law is not it's also mindful that taxes that have been paid in other jurisdiction. If you have paid taxes in other jurisdiction, there may be consideration around who should account for the tax. But because the asset is here, if the income is generated from the asset, then there should be tax in that note. I hope that is clear. Hello?
Yeah, thank you very much. I think we are able to do justice to that. On this note, I want to sincerely appreciate all our participants for being part of this program. Can I still accommodate this before I move to the next one? 1 minute so that we can do justice to everyone that is very much present here.
Okay.
It is my firm belief that unless the Constitution of Federal Republic of Nigeria is amended, the issue of cross-pollination of tax will persist. However, I humbly suggest that the NRS, okay, I think this is more of suggestion on the part of the participant in this particular program. On this note, I want to appreciate everyone for being part of this program. I quickly want to roll out some of the announcements that we have before we come to the vote of thanks. First and foremost, to all our members that have always been participating, I want to encourage us all to try as much as possible to pay our subscription because it's our obligation. Just the same way tax is an obligation to us to the government, your subscription gives you that wherewithal to call yourself a proud member of our great institute. And we encourage you to please visit our website portal and make sure that you make the necessary payment expected of you as your subscription. Also, we want to encourage you all to try as much as possible to visit our social media and visit our WhatsApp channel to have a first-hand information of the activities of the Institute. All other social media and visit the Instagram, the LinkedIn, the Facebook, the TikTok. There's always an information for you on whichever. If you go to the chat room, there are links that are actually meant for this, especially on our YouTube channel. You can definitely have access to all our previous session on this webinar series and all other program of the Institute, because we always hear them, stream them online. So we encourage you to visit all our social media and have a first-hand information of every of our activity. Also, attend our MPTP program so that you can meet up with your credit hours that is actually being expected of you every year. As regards this program, we are tracking the attendance of every participant and working administratively. Every of those credit hours will be credited to all financial members. It's not just possible that you see the financial members from my voice, but I'm actually painting it in capital letter to emphasize it. Make sure you pay your subscription as MPTP credit hours will only be given to the financial members. The administratively, we are working on that, and in no distance time, we'll definitely credit that all. I was able to have an engagement with the DR. The papers that have actually been availed to us by the facilitators will be hosted on the portal. Visit the CITN events.org and put in your membership number. You will definitely have access to this. I have the commitment of the IT department that would definitely be put to place today unfailingly. So please visit CITN events, that is with the S, events.org, and log in with your details to access the available paper presentation by our presenter. On this note, let me invite the Deputy Registrar as he gives us the vote of thanks. But Deputy Registrar, before you go, somebody is asking me, how do we pay our subscription? Visit the website and you will see the payment channel there. The outstanding you are owing, if it's beyond 1 year, is definitely there. Click on it on the click of button. Very simple, easy to do. I have to come back to that because it's very important to me that you pay your subscription so that you definitely be avail those benefits that is meant for financial member. On that note, let me welcome.
Can I just make a quick comment before we hand over to the Deputy Registrar?
My chairman, you have the floor.
Professional colleagues, watching some of the questions that have been coming up both in this and previous webinars, I do have some concerns that people haven't truly understood the magnitude of the changes, and also that there's a time now of self-help. Do not think you knew what the laws were. They have changed where they are. And some of these questions also cause one to pause and think, did you really understand the laws before? Now is the opportunity to really understand the laws. I can't overemphasize this because including people who are asking about complaints resolution and other things, all of these things are actually answered in the Acts. It's boring, but for some of us, it's exciting reading. Please have a look at the material. It's very, very important. Back to you, moderator, please.
Thank you very much, my chairman. If you're in the chat box, you have a number you can reach out to. If you're having challenges, you can chat this number 0908 88815. Just chat that particular on WhatsApp 0908 08888. That is quadri 815. Make sure you are a financial member so that you can have access to all that is your entitlement. And don't forget that you need to preach this gospel to people around you. The induction comes up in November and it will be in Lagos. For the lawyers, there is going to be a transition program also in October. Try as much as possible to visit our social media handle. This information are well grounded there, and you'll definitely be happy you do that. On that note, let me welcome the Deputy Registrar, our own Mr. Waid Ghani, FCTI, as he gives the vote of thanks. Over to you, sir.
Thank you very much. What an enriching session this has been. The 11th deep dive webinar on Nigeria's new tax law has not only deepened our understanding of surcharges, incentives, and safeguards, but has also carried forward the remarkable tradition we began from the 5th edition, a weekly engagement that continues to draw tremendous participation from professionals across Nigeria and beyond. We are deeply grateful to our president, the 17th president of CITN, Mr. Innocent Chinyere Ohagwa, FCTI, whose visionary leadership keeps raising the bar for this institute, and whose visionary leadership to the executive committee, the council members, and the past presidents, we acknowledge your enduring guidance and legacy. We also thank our Registrar Chief Executive, Mrs. Afolake Osho, FCTI, and the secretariat team for the dedication that they have put into ensuring that we have this week in, week after. Our appreciation goes to the chairman of this session, and who has always been there for us, Dr. Mark Abani, FCTI, for setting the tone with wisdom, and to our lead presenter, Mr. Fidelis Shuku, FCTI. Thank you so much. And to our distinguished discussant, Dr. Kabir Abba and Mrs. Ashiata Agbulaje, we thank you so much for the practical insight that you have put in today's dialogue, true though, and they are very, very impactful. We equally commend our moderator, MC Easy, for skillfully guiding the session. And to our valued partners and collaborators, the Federal Inland Revenue Service, the State Internal Revenue Services, KPMG, Deloitte, PwC, Ernst & Young, Ascension, Crested Pedabo, and so many others too numerous to mention, and individuals who have contributed in some way to this program. Thank you for walking this journey with us and for strengthening our impact. And finally, to our participants, you remain the heartbeat of this series. Your active presence and questions affirm that this initiative is meeting its purpose. As we close, let me urge you, these webinars are only an overview. The true responsibility is yours. Take the Nigerian tax laws, all of them, study them carefully, internalize their provisions, and let your professional actions align with the law. In doing so, we will not just tax smart, but also incentivize growth, strengthen our profession, and contribute meaningfully to Nigeria's progress. Thank you so much, and we look forward to having you next week, Thursday, in another program. Our signature program again, CITN Taxation and You, and we'll continue this conversation on this incentive as it is an endless discussion. Thank you, and till next week, see you again.
Thank you very much, the Deputy Registrar, for that vote of thanks. As we bring this program to a close, let me reiterate Our signature program comes up next week, Thursday, by 11 a.m. I'm sure you know every first Thursday is always an engagement, and it's continuation of this webinar series on the New Tax Act. So please make it a date with us next week, Thursday, on CITN Taxation and You. And we promise you that definitely it's going to be an insightful time. Don't forget, there is always a question with a gift for those that partake in CITN Taxation and You, courtesy of the Institute. Make it a date with us to be on the program next week, Thursday, as we come with another perspective of the New Tax Act 2025. Until then, be a responsible professional, be a responsible practitioner, make your country proud by contributing your own quota to the growth and the development of your nation. Until we come your way next week, Thursday, stay blessed and have a wonderful week ahead. Thank you.